Well, hello again, students. This is Professor Ashley, and today we'll take a look at lesson number 3 from your syllabus on the Introduction to Accounting. Lesson 3 is based on a single chapter, Chapter 5, unlike the first two lessons where we took 2 chapters at a time. And here we focus on the issue of inventories and calculating the cost of goods sold. Inventory is a very important part of a merchandising firm's accounting process. It does not apply to the service firm, does apply to the manufacturing firm as well, where in fact manufacturers have multiple inventories, that is raw material inventories, goods in process, and finished goods. So we're looking at primarily today the merchandising firm, which has just goods available for sale. There are 4 learning objectives in this chapter. I want you to read it carefully, but I'll point out the important sections and highlight what you need to do to prepare for the quiz, which will take place during the week, as well as the homework assignment. We have 4 basic learning objectives in this chapter. The first is determine the cost of goods sold and ending inventory. Inventory is taken in one of 2 fashions, either periodic or perpetual, and we're going to examine the perpetual inventory system. Under the system, the accountant simply enters each purchase of inventory as it's acquired and records the cost of the inventory that is used as the inventory is sold, as it takes place on a continual basis. This is called perpetual inventory system, and there are 4 methodologies that we can employ in measuring what goods, or what is the cost of goods that have been sold during the year, by recording the starting inventory, the ending inventory, and adding in all the inventory purchases. We can make a simple calculation to determine the cost of goods sold. However, there is a catch. Not all inventory purchases are going to be the same during the year. The cost of materials or the cost of your product can be rising or falling. A simple example would be a gasoline station, where the cost of the gasoline is purchased from the big tanker truck will vary from week to week, rising and falling. So we need to determine which units of inventory are being sold. Is it the first units acquired? That system has a name. It's called first in, first out, or FIFO, F-I-F-O for short. Or is it the last units that are purchased that are being sold? This is called LIFO, or last in, first out. Normally, inventory moves physically on a first in, first out basis, but we're allowed under accounting practices to use either methodology. That is, count the last goods as the ones sold first, or the first goods as the ones sold first. This is going to make a profound difference in the cost of goods sold if prices are generally rising or generally falling. It's important to note at this juncture that prices in the U.S. have been generally rising over the last 50 years, and we refer to this in economics as an inflationary environment. The opposite is called a deflationary environment, where prices are steadily falling. Clearly, if you take a look at recent history, and you'll see that prices of most goods that consumers purchase have been rising: food, gas, housing, etc., etc. So we would say the normal circumstance is an inflationary environment. If this is the case, then the last goods sold, or purchased rather, last goods in would be the most expensive, and the first goods in would be the least expensive. By utilizing the last goods as the first sold, we are stating a higher cost of goods sold and therefore a smaller profit. The opposite would be true if we're using first in, first out. under the normal inflationary assumption. Keep in mind that assumption is not always true, although it has been for some period of time now. There are two other methodologies for valuing inventory sold. One is the weighted average, where we simply multiply the number of units acquired times the cost and divide by the total amount of inventory used. Gives us a weighted average for each subsequent sale of units. There is a fourth method called the specific identification costing method, and this is applied generally to merchandise which is not uniform. That is to say, each item is a separate item. Excuse me, please. A good example would be a car dealer, where each car has a specific cost, and we keep track of the cost of that car independent of the cost of other vehicles. Planes, real estate, other large ticket items tend to use this methodology as being the appropriate one. As we value the inventory, we are then having a profound impact on the cost of goods sold, which in turn has a profound impact on the profit statement or income statement and the profits that the firm earns period by period. Also, we have to look at the issue of cost versus market. Do we record items at their cost or at their current market value? There are some circumstances that require the accountant to value inventory at market rather than at cost. However, the normal course of events requires that we record items at cost. Now, this is an extension of the conservation principle or principle of conservatism, which says that you should only record items that you can actually back up with some kind of receipt or evidence. Clearly, with inventory, the cost of the inventory is recorded and can be substantiated, whereas the market value is a judgment call and not nearly as accurate for most purposes. After discussing these items, the book then turns briefly to the issue of fraud and how can we avoid fraud or control it. Clearly, inventory can be stolen, but it can also be manipulated. That is, its value can be manipulated by management to serve their own purposes rather than those of the actual owners of the firm. Here we're talking about the corporation specifically, where the stockholders are not the management. Fraud control can be done in a variety of ways, and the book gives us a brief outline of these methods and ideas that need to be incorporated in our accounting practice. A fuller treatment of fraud is covered under the auditing series of courses that will be offered in this fall, I believe for the first time in some time, and I will be teaching those courses, Auditing 1 and Auditing 2. Of course, an auditor is a specialized accountant who looks into the records and reports of the accounting staff to see if they contain any mistakes or deliberate mistakes, which we then term as fraud. And finally, profitability, again, is the issue here. Cost of goods sold is subtracted from revenue along with other expenses to yield the profit, and inventory being a rather large part of the firm's cost of functioning is going to play a large role in fluctuations in profits. So how we record and how we measure our inventory uses, whether it's first in, first out, or last in, first out, is going to have a profound impact on the profits. It's important to note at this point that firms are discouraged from switching methods from period to period, and if you switch from FIFO to LIFO, you can do it perhaps once in the life of the firm. A second time will provoke an audit from the IRS, which is something that almost everybody wants to avoid, except the IRS themselves, of course. After reading Chapter 5, We have assigned a series of exercises and problems from page 268 to page 277. Problems 1, 2, 3, 4, 6, 8, 9, 21, and 24. And each of these is to examine a particular part of the process of accounting for cost of goods sold and the recording of proper preparation of the income statement. Note that there's also a comprehensive problem from page 290 to page 291, and this problem is the one that we will examine in class next week. Of course, this week we will spend our time on the comprehensive problem from the previous lesson, which covered chapters 3 and 4. So those comprehensive problems will be the bulk of our classroom activity, so that we can see that you have indeed mastered the processes that are being introduced at each of these successive lessons. There is an online quiz, and that online quiz you need to take at some point during the week. I will just give a brief listing of items that are included on that test. There is mention of that inflationary environment, and you need to know which LIFO or FIFO is going to result in the larger or smaller cost of goods sold and the eventual impact on profits, depending on whether the environment is inflationary or deflationary. The effects of different accounting methodologies, the four we listed earlier, on the income statement are included in various questions, multiple choice questions on this test. There are questions involving cost or market calculations, and there is specific reference to the choice of LIFO or FIFO as the inventory valuation methods or accounting methods. When do we use them? What impacts will they have? These appear on the little quiz, 10 questions at the end of the chapter. Those carry a fairly heavy weight in your final grade, so you want to be well prepared for them. Make sure that you have examined the vocabulary carefully and understand what the terms mean, and it's quite all right to have your book ready as you take this test in front of you for last-minute checks of terms that you may not understand. The nice part about the multiple choice test is simply that the answer is there, and if you recognize the answer, it's very easy to take one of these. If you don't know what the vocabulary is, what the words mean, it's easy to become confused and put in a wrong answer. So this concludes our discussion of Chapter 5. You should read it carefully at least one time completely. I prefer to see you skim it and read it several times, paying attention to the most important parts before you do a final read-through. This will prepare you for the final exam, and of course working through the problems is the ideal way to understand how the accounting system works, and in particular this very important Chapter 5 dealing with methods of valuing beginning and ending inventories. Thank you very much.